welcome back to the show. Well, IT heavyweights TCS and HCL Tech will be kicking off the earnings season today. Sumeet Jain, the IT analyst at ICICI Securities, joins us now to talk more about that. Sumeet, hi, good morning, and thanks for joining in. This is there are many firsts, right? I mean, this is the first time that HCL Tech is reporting before Infosys. This is the first time that at TCS you have Mr. Kriti Vasan also on board, and this is the first results post his joining in. So lots to talk about. Tell us, what are the top 2 or 3 things that you're watching out for? And in general, how are you approaching the IT pack?
Yeah, good morning, Sonia, and good morning to your entire team. So I guess clearly, going into the quarter, I guess the quarter is pretty weak as per the demand commentary from all the company managements. And I guess what we would be keen to watch for is the order book, first of all, because I guess there is a clear focus on cost optimization deals by almost all the companies, particularly the larger ones. And I guess that will give them a slightly longer visibility of the revenue growth going forward. And I think that given that the smaller deals are shrinking, if you look at the Accenture commentary, clearly I think that will create headwinds in terms of order book conversion to revenues in the near term. So this is where I think we are more positive on the larger companies like Infosys and TCS going into the results season and over the next 2 to 3 quarters, given that there are a lot of headwinds for the sector in the near to medium term, not just because of macro slowing down, particularly in the US geography, where, retail, high-tech, telecom, and banking, which contributes to almost 70 to 80% of the revenues for these companies, is slowing down. So I guess in the current environment, clearly you have to focus on those companies which can stitch large deals on the back of their capabilities, and that will provide them the growth visibility for next 2 to 3 quarters. And then you also have to look at the valuations for the sector. Nifty IT right now is trading at around 21 times 1 year forward, which is still at a 10-15% premium to the broader market, whereas the earning growth for the Nifty IT and the broader IT sector is still, mid to high single digits this year compared to broader Nifty at mid-teens. So I think from the valuation perspective, it is still not very attractive, and there could be further correction if the next 2 quarters are going to be weak, which seems to be the case based on the recent Accenture commentary, as well as the commentary from all the Indian IT companies. So yeah, I think what we will be keen to watch will be the order book by these companies, any signs of demand improvement, and also the impact of generative AI on the broader industry. We are seeing news from almost every IT company trying to train as many employees on these tools. Wipro just came out today morning saying that they will invest $1 billion in it over the next 2 to 3 years. Accenture in the last earnings call said that they have already received $100 million revenues in the last 3 months, and they're planning to invest $3 billion. So I guess the partnership with the hyperscalers out here in terms of particularly Microsoft Azure, AWS, and Google Cloud will be very critical, and how companies will be evolving their generative AI solutions. So my only fear is the generative AI should not have an initial negative impact on the industry the way we saw for cloud and SaaS back in 2015 to 17 period.
All right. Hi, Sumit. Good morning. Nigel on this side. Sumit, I wanted to ask you about HCL Tech in particular, because there's a lot of pre-positioning that's taken place out there. In the last 4-5 sessions, the stock is down 7-8%. Could that be an additional negative that sees the stock getting a further knock from here? And I ask this because I think it's one of the fastest growing IT companies. Also, it has some kind of valuation comfort. So how would you approach the stock from here on, and what could be the key numbers we should work with for HCL Tech, according to your estimates?
Yeah, I think in case of HCL, we believe that they might cut the top end of their guidance this time around. So we are expecting a flattish growth for them this quarter in terms of QOQ growth in CC terms. And their ER&D business will actually face quite a lot of headwind because the projects cancelled last quarter haven't revived as per the company management this quarter as well. So I think the street is building in a higher estimate for them. So there could be a bit of a disappointment. But yes, even despite the cut in the top end of the guidance, we are expecting them to probably guide for a 6 to 7% kind of a growth for this year, which will still imply they will be the fastest growing company this financial year. And this is where, if you look at our target price, almost close to 1,200, we have almost 8 to 10% upside on the name, and we have an ad rating. I think the only problem in case of HCL is the consistent improvement in ROE and ROCE we have not seen for last several years. But yeah, I think there is a clear scope for a bit of a re-rating for them, given that they will be the fastest growing company this year.
Okay, all right, Sumeet, thanks so much for stopping by and giving us your views, on what to expect from the IT companies, as well as a couple of them that will come out today itself.